All right. Hello and welcome back. In this lecture, I'm going to run through the key takeaways from the growth lectures. Now, the whole series is called Value of Growth, but if you've been following along, we talked about market efficiency, we talked about valuation, we talked about competitive advantage, we talked about a bunch of things. The last, half dozen lectures have really been focused on the growth component of the Value of Growth lecture series. I even made a joke that we had to get to lecture 26 or whatever it was before we start talking about growth in a lecture series called The Value of Growth. All right. So what I want to do today is the key takeaways from the growth lectures part of the Value of Growth series, if that makes sense. The next lecture I'm pretty sure I'm going to do is a key takeaways from the entire course. And then after that, I'm going to do a how to use the Italian cookie as a valuation method. I'm going to walk you through how I think about it and then look at some of the interpretation. And then I have a couple others after that, I believe. All right, so let's get started. All right, slides go forward. All right, the reason we cared about competitive advantage was that if a company did not have a sustainable competitive advantage, then that blue layer of value, those excess returns, the cash flow from those excess returns would over time slowly disappear. We draw this as a gradual erosion, but you have these competitive pressures coming in that are coming after those excess returns and those cash flows. And that layer of value will disappear. And essentially, the market implied value of growth will go away. And it's a very straightforward idea that if a company can't create incremental value, if that incremental growth is not greater than the cost of capital, there's no value created from growth. It's very simple. So competitive advantage is where the whole story starts. If the competitive advantage starts to erode away, then that market implied value of growth will disappear. So that's sort of where we started. All right. I then talked about the importance of thinking through the power of compounding. And there's famous quote from Einstein who said the eighth wonder of the world is compound interest. And it's that exponential. It's an exponential, so it gets bigger faster over time. And when we think about what I call hypergrowth, you think about high growth companies, it's not 7% gets people excited, although 7% compounding can be quite powerful. But what gets people's juices going, and I think what really people think about as growth investing is something 15%, maybe even 20% year over year growth. It's really important to appreciate that over time, that compounds to a very big number. That's all. Just keep that in mind. It's the exponential factor of growth really does get bigger faster. And so keep that in mind when you start to pay for that high level of growth. And I walked you through some work that was done by Bain & Company, two partners at Bain & Company, where it just said, if you go look at the performances of companies, guess what? It's very few of them actually earn their cost of capital over time. It's a very small pool. So base rates, talk a lot about base rates. So the base rates are, be careful about the exponential power of compounding growth, particularly at high rates. And when you go look at history, realize not many companies do it. Even at this hurdle was 5%. So, just be careful, All right, I introduced a concept called hypergrowth. Hypergrowth is really driven by the life cycle adoption curve. We talked a bit about where that came from. We then talked a little bit about how Jeff Moore added an important nuance that you need to cross the chasm to get into the early majority. And it's the early majority where you really enter hypergrowth. I've been thinking about electronic vehicles, and in my conversation during the lecture, I challenged and said, have EVs crossed the chasm? And I said, no, they have not. I don't think they have. Didn't get much pushback. All right, maybe yes, maybe no. And I was talking to somebody over the weekend about this very issue, and they made the observation that really hybrids is probably the market that could go into hypergrowth if the company's focused on it, because you get the best of gas, you get the best of EV. So just as an observation. So you've got to get into that early majority to enter into hypergrowth. That's what's really important. You then get into high growth, and there's some cool things that happen during hypergrowth. And this was something that Jeff Moore gave us. He's been listening to the lectures. Thank you, Jeff. And the key is that the best indicator that you're in hypergrowth is that there is budget at these companies for the product. Budget, whether it's consumer or a business, there's budget. They actually are looking to solve a problem or meet a need of some kind. And they have budget for that, and they have budget for the category. And that's really, he thought about when you're early adopters and maybe the early stages of the early majority, you're effectively stealing money from another part of the budget to pay for this product. But once the budget then comes around for this product, then you enter hypergrowth. I thought that was just a great nuance. So thanks, Jeff. All right, so then I introduced this idea of the investment rules in hypergrowth. And the big thing here is that growth is the only thing that matters. And I get a lot of pushback on this, which I understand. But it's really the most important factor. Now, when you go through market turbulence or when rates start moving around, you introduce a lot of short-term volatility. Staying convicted in short-term volatility is hard to do. But I stand by that growth is the driver, the most important driver. And valuation, I say here, doesn't matter, but it's certainly a secondary consideration. That's the key. And when you get in that hypergrowth, you really want to focus on growth. Now, because we've narrowed it down to growth being the most important factor, you don't get other places to hide. So if growth slows, guess what? Hypergrowth's over. And that's the key. Now, what makes this so powerful is if the return on capital is greater than your cost of capital, then you create enormous value going through hypergrowth. And if your growth rate is greater than your growth rate, that was good. If your growth rate's greater than your growth rate. No, if your return on capital is greater than your growth rate, you have this, Lollapalooza effect, which I took from Charlie Munger. I'll show you what that is in a minute. All right, and then I showed that this is what happens is these are the Italian cookie CAP charts, competitive advantage charts. And you can see as you go through hypergrowth, you see this huge expansion in the area under the curve for these Italian cookie charts. And that is your enterprise value. And that's why these stocks really explode, because you see this huge increase in the enterprise value of the company driven by higher invested capital, higher return on higher present value competitive advantage, and then higher market implied value of growth. That's the key. And remember, we're focused on growth. That's why we're focused on growth. All right. And it's really important that growth is greater than the cost of capital. If the growth is equal to or less than your cost of capital, then your growth's going to hurt you. Potentially hurt you. But when the growth is greater than the cost of capital, really cool things happen. Now, is it possible to overpay when you're looking at growth company? And the answer is absolutely. It's that point where growth slows. And that's really important. So growth is the primary driver, valuations of secondary concern until, guess what? You hit that inflection point when growth starts to decelerate. The moment growth starts to decelerate, you get competitive pressures, and competitive pressures start to potentially negatively impact profitability. All right, that decelerating growth, it becomes really important. The investment rules are valuation now matters. Competitive pressures return. Traditional competitive advantages are tested. So you need to go now brush off your competitive analysis, competitive strategy, all of those tools that we had in the middle of the lectures. And that can take a while to unfold. The turbulence that's caused when you go from high growth, hypergrowth to decelerating growth, and because it takes a while, that revaluation, it can be painful for sure. And it can take a little while, and it's hard to live through. Frankly, it's hard to live through. So this is, the good news is we sort of know what the rules are. The bad news is you got to be strict, really important. And this we talked a little bit about those pressures, right? All right, did talk a little bit about the Guerrilla game. I think that this is a good overall guide on how you want to think about two different types of companies in hypergrowth. One we call the Guerrilla game, the name of the book, and the other, the royalty game. I said it at the time. I'll say it again. This is really Jeff Moore, really creative. He came up with this idea. And the key here is each requires a different set of investment rules. So in the Guerrilla game, you end up with a gorilla, chimpanzee, and a monkey. I know that primates don't really interact, but it's a good metaphor. These are generally true software companies or true platform companies, inherently scale businesses. And the strongest gorilla have true network effects. And we see that. That's the key. The royalty game is a bit different. I've been watching Henry VIII, Wolf Hall. I found out this is a very famous painting. This is the most famous painting of Henry VIII. Did you know that Henry VIII ruled 500 years ago? I didn't realize that until I started watching these shows. All right, the royalty game. King, prince, and serf, they do interact. This is generally businesses that we would call hardware or non-network effect platforms, that have a modest software component. The problem here is Moore's law, not Jeff Moore, but Gordon Moore's law, erodes the hardware-based competitive advantages over time. And that's really the key insight there. All right, so here are the rules. In both of them, you generally are buying the category. You buy all the leaders. So you don't necessarily know who's going to be the gorilla, who's going to be the king. All right, on the gorilla game, you as the gorilla emerges, you can sell off your monkeys and you kind of monitor the chimps because they can do well for a while. When chimps start to falter, you want to sell them, and you're left only with a position in the gorilla. And the work we did when we published the book, and I'd be willing to bet it's the same now, is you make more than enough money on the gorilla, capturing the gorilla, to offset any losses you have on monkeys or chimps. I mean, I firmly believe that is the case. So you buy the category because you're not sure. If you are sure, don't buy the category, buy the gorilla. All right, in the royalty game, you want to buy kings and princes, avoid the serfs. They never do well. Sell the weak princes as they stumble or merge. And you sell the king when the growth slows. Whereas on the gorilla game, you may want to hold your position through that turbulence where you go from high growth to decelerating growth. All right, so now when the growth slows, what do? In both cases, the growth is decelerating. Now, in the gorilla game, valuation resets, and that could be painful, a bit painful. Certainly, turbulence emerges in the industry and volatility emerges in the stock. Gorillas survive if you've captured it correctly and ultimately recover, generally is the case. Chimps generally become irrelevant and monkeys disappear completely. All right, in the royalty game, growth decelerates. Competitive pressures return and traditional competitive advantages are tested fairly quickly. And because these are not scale businesses and they don't have network effects, then guess what? It's a battle for profits begin. And those competitive advantages are really actually tested, and you can see who survives. Valuation, again, matters. So you have more turbulence, more volatility in the royalty game than you do the gorilla game. Kings usually survive, but at a much lower valuation. It's best just to sell them when the growth decelerates. All right, then after we talked about hypergrowth, we talked about modeling traditional growth, which I think is important. And I just walked through the steps because I think when it comes to growth, people have a bad habit of getting lazy. And they'll say things like, revenue growth without thinking through the steps. Now, what we're looking for is NOPAT growth. So we got to do at least a little bit of thinking through this. All right, so unit growth is equal to industry growth plus or minus changes in market share. This is really, really important, subtle. So the only way for a company to grow faster than the industry is to capture additional market share. That's a fact. And if you have an investment and you believe the company's going to grow faster than the industry, you need to be able to explain how the company's gaining market share. And if a company's gaining market share, it means that the customers are not being loyal to the other vendors, which then calls into question how much customer captivity there is. And our definition of sustainable competitive advantage has at least some customer captivity. So there's some subtlety here, the nuances that's really important. All right. And it's very, very hard to gain market share in a high return business. Why? High return businesses have customer captivity, almost by definition. So guess what? Your base rate, industry growth rates. And there's a great fallacy because many companies attempt to deliver growth greater than the industry growth rate. They enter a growth trap. And a growth trap is really defined as continued revenue growth. You get the revenue growth, but declining profitability. Expenses are growing faster than revenues as management chases growth. That incremental customer is expensive. And so you get the revenue growth, but you don't get the NOPAT growth. And that's key. NOPAT growth. All right, so revenue growth is unit growth times changes in prices. For a long time, we were very lucky. We didn't have to think about changes in prices. We had low inflation. If anything, there was more deflation in a lot of markets than inflation. Unfortunately, now you have to think through that a bit. Changes in prices. Inflation is back a bit. Looked like it was being dampened. Some of the economic policies look like they may put pressure on inflation. So bad news, you have to start thinking about units and prices. Units and prices, that's the key. All right, then NOPAT growth, that's what we care about, is revenue growth times changes in NOPAT margin. And in the core lecture, I talked a little bit about how you want to think about it. I won't go into detail here. All right, so then I wanted to show what I think is, for me, was one of the great breakthroughs in my thinking. And that was this idea that when you grow NOPAT faster than your discount rate, you end up with what Charlie Munger would call Lollapalooza. I thought was really insightful. So there's your annual NOPAT at a 12% growth rate. There's your annual NOPAT, present value of that NOPAT at an 8% discount rate. And what's here is that each time the company can grow faster than its discount rate, it's really important. They create more value in the next year than they did in the year before. So the longer they can grow faster than the discount rate creates enormous incremental value. That's the key insight. That's what's really important to keep in mind. That's that Lollapalooza effect. So each year gets larger. So the faster they can grow, the longer they can grow faster than their discount rate, the more value they create. And that's what really drives valuation expansion in hypergrowth. This is the final link to the whole thing. And I walked through the math just so you could see it. NOPAT grows at 12%, right? We grow NOPAT at 12% and we discount it back at 8%. And that's why you get this ratio of greater than 1. So just say it one more time. When a company can grow faster than its discount rate, each year it can do that, creates enormous value. It's that phenomenon, that mechanic that drives the valuation expansion in hypergrowth. All right. And then I just showed that this is an upward slope because G is greater than the discount. Growth is greater than the discount rate, which is pretty important. I think this, for me, is really the definition of hypergrowth investing, is betting that G will continue to be higher than R. G growth is higher than the discount rate. And I think that's what really drives it. So for me, hypergrowth investing is really that. The other things I talked about are true, but this to me is a core piece of all of that. All right, I then took those 5 stages. I modeled the company, growth rate of 12, growth rate of 8, growth rate of 4, no growth, and then negative growth. And then we discount that back. I did do brain freeze. Hyperbolic discounting, which I've gotten some pushback on, and I understand it's hard sort of to conceptualize. Once you play with this enough, I think it makes perfect sense, but I recognize that it's not obvious. All right. Once I did that, we model the whole thing. You end up with what is I referred to as a cap chart, taking the work Michael Mauboussin and I did 25 years ago or whatever it was, and you create these cap charts. I think they're very valuable to understand how the market values companies, but they also help with understanding why stocks go up over time, which is important. All right, I just do this so you can see our main drivers of valuation are all visualized here. We've got magnitude of the cash flows, duration of cash flows, and growth of the cash flows, which ties right back to our original valuation table, which is great. All right, so here's the key. As time moves forward, the key here is if the company holds its competitive advantage, guess what? You'll pick up value every year. That's the key. But the key insight here is if the company holds its competitive advantage. This is where competitive advantage comes back to growth, becomes really important. And what you get is that growth. If the competitive advantage starts to erode, that secondary cap chart will start to collapse on the gray one. The blue will collapse on the gray one, which is important. And in this case, EV will increase by 12%-ish, which we can show mathematically. I'll give you the formula momentarily. If you go 2 years, guess what? Same thing. But this is if the company can hold its competitive advantage. If it holds its competitive advantage, you get this. So long-term investing is almost exclusively about being able to get the competitive advantage essentially correct. And if you do it 2 years, guess what? It's 2 years compounded, which is pretty cool. I refer to this as a soft catalyst, passage of time. Now, It requires a constant PE to make this work, and a constant PE is a stable incremental growth plus consistent incremental return on capital. It's that simple. Is if they hold their competitive advantage, that incremental return on capital will equal the historical return on capital, and the PE will hold. And what we'll see is the cap chart kind of just marches forward, and you pick up that value every year. Now, here's the formula. It works very well. Your return is essentially cash yield plus growth if you assume a constant PE. A constant PE assumes a constant return on invested capital, incremental return on capital. So I think it all ties together pretty nicely. And there is another way to think of your return. 1 over the PE, that's essentially a proxy for the cash yield plus the annual growth rate if the PE holds, which means if the return on capital holds. That's sort of the key. And here's a company that a more mature chart where you don't have that positive growth at the beginning. You don't have that growth greater than your cost of capital. You don't have that early hump. This is a more mature company. And guess what? When you model it, it works identically the same. So when I went and did this model, the 1 year return is 10.3%. Your cash yield was 7.3%. Your growth was 3%. So there's the math for you. All right, let me wrap this all up. Here's a couple of things where you can model growth. Early on, a couple of lectures ago, we talked hypergrowth. I came back to, that to me really is the changes in investor expectations drive stock prices. We know that. Growth is the most important factor in hypergrowth, and so valuation is generally not important. Focus on incremental growth and incremental return on capital. All right. DCF has some strengths. It's a terrible valuation tool, but it's a great way of looking at the capital efficiency of a company. A DCF is a great way to model that. Really important. So I think for the explicit forecast period, a DCF is a very powerful way to model it. You really get to understand the economics of the business. And then finally, earlier, a couple of lectures ago, we talked about the market implied value of growth. I think that's important, particularly where you compare the market implied value of NOPAT growth against the industry growth rate or the organic growth rate of the company. I think that's very powerful. Here's a couple of calculations that I used. If you're interested, go back and watch that lecture. I think it's pretty cool. Key, don't overpay for growth. Don't overpay for growth. Now, when you're in hypergrowth, you're not paying for your valuation is less important. Key. All right, so here's a couple of what I call the Italian cookie metrics. When you think about invested capital, it's really the replacement value. Now, that's hard to do for most companies, so I use historical invested capital just as a placeholder. And as long as you're consistent, we're not looking for precision. All right, when it comes to competitive advantage, the two most important metrics are incremental ROIC, that return on the incremental capital invested, and sequential changes in ROIC. You want to just look and see what's going on. Now, they're related, obviously. If your incremental return on invested capital is less than your historical return on capital, guess what? Your incremental, the ROIC will sort of trend downward. If your incremental return on invested capital is higher than your historical return on capital, then your ROIC, overall ROIC, will trend higher. Okay, not that hard to see it. Companies where the ROIC is expanded tend to be companies where the stock goes up. Not always. Tend to be the case. When ROICs are starting to fade or decline, those stocks tend to go down. That's why we care. All right, growth. What are the most important metrics? Recent versus growth, recent versus trend line. I always look at quarter to quarter and year over year. For companies with any seasonality, you can only look at year to year because the seasonality sort of messes with the quarter to quarter. Companies that are early in hypergrowth with not natural seasonality, you want to look at quarter to quarter. That becomes important because guess what? Growth is your most important driver. I look at incremental growth. Is that trending up or down? So just look at the pure growth rates. And then you kind of calculate the market implied value growth rate and you look at that sort of against industry growth or comps. I think that's my last slide. All right. So that's my key takeaway in my growth lecture. My next lecture, I believe, I'm still in the planning stage, will be a takeaway of kind of the whole course. Again, fairly short, and then we'll do some other fun stuff after that. Thank you for listening.